Did you know that the key to your dream home might not be in a traditional mortgage? Welcome to Unlocking Home Dreams, why FHA mortgages are every buyer's best friend. In today's episodes, we're diving deep into the world of FHA mortgages, revealing secrets that could revolutionize your home buying journey. From first-time home buyers to seasoned investors, there's something here that might just change the way you think about financing your home. Stick around, and I'll unveil a surprising fact about FHA mortgages that could save you thousands of dollars. Trust me, you don't want to miss this. Now, you may have heard that FHA mortgages are just for first-time home buyers. Well, that's simply not the case, and that's really just the tip of the iceberg when it comes to myths. So stick around as we dissect some of these myths and highlight the benefits, reveal some of the surprising truths. My goal is to provide you with as much information as I possibly can and educate all home buyers, folks interested in real estate and in the economy and how the economy affects real estate. So if you have any questions or you have any thoughts, don't hesitate to drop your comments. Please do me a favor, make certain that you give me a thumbs up over there, subscribe, and share. Happy to help answer any questions and look forward to the rest of the video. And when it comes to credit scores, many mortgages can be unforgiving, but FHA mortgages, they're a game changer. While conventional loans often demand higher scores, FHA is more understanding. Imagine being a young couple just starting out. Maybe you had some financial hiccups in the past, a missed payment here, a late fee here. With FHA, you're not defined by your past mistakes. I want you to think about being a self-employed individual. Maybe that might be not that hard if you are. And you've had to manage your cash flow over the last several years. So think about the ups and the downs of the economy, employee turnover, lack of inventory, COVID restriction, the list goes on. A blip on your credit or your income should not keep you from owning a home, ever. FHA gives you the opportunity. It keeps that dream alive. Now let's talk about the debt to income ratio. It's a fancy term that lenders use to see if you can manage your monthly payments. And guess what? FHA offers leeway here more than most. For families juggling multiple expenses, from school fees to car payments, a higher debt to income ratio can be a reality. FHA understands this, making home ownership accessible even when financial going gets tough. 1099 employees are actually seen as a self-employed individual in the eyes of the IRS and in the eyes of a lender. So what many forget, when you file that Schedule C, several write-offs are being taken, and they tend to lower your usable income in the eyes of a mortgage underwriter. This may limit your ability to borrow. FHA allows for higher debt-to-income ratio, which could be your saving grace to get into that home. If you're an entrepreneur, self-employed borrower filing a separate tax return for your business, you too can find an FHA loan very helpful when it comes to leniency of getting approved when it comes to DTI. Many times our accountant or CPA friends will do their job and provide you with the lowest tax liability. Great when it comes to paying the IRS, but when you borrow, it can be a challenge due to provable income. Down payments can be a major hurdle for many. But with an FHA, you can secure your dream home with as little as 3.5% down, given you have a credit score of at least 580 or more. That's a game changer for many families. For first-time home buyers, conventional loans do allow you to do 3% down. However, it could be your 10th home purchase, and FHA will still allow you to put down as little as 3.5%, assuming you do not have another FHA mortgage. And there are some caveats to that where you can have two, but there's a distance requirement. And again, another topic for another episode. And for those that have anywhere from a 500 to a 579, you still have an opportunity to take advantage of an FHA loan. You can put down as little as 10% and still qualify for that mortgage. One of the beautiful things about an FHA mortgage is that they allow you to take advantage of what's called a compensating factor. Some examples of a compensating factor are a larger down payment, additional funds in the bank, whether that's IRA, 401k, any sort of retirement funds where you have reserves set aside that can be used as a compensating factor. If your debt to income ratio is on the lower end, That's a compensating factor. These compensating factors can help make that transaction possible, even if you are on the lower end of the credit score, and even if you have a lower down payment to put down on that purchase. In a world where financial hurdles can seem insurmountable, FHA mortgages stand out as a beacon of hope. They're not just a loan, they're an opportunity, a dream realized, and a testament to the belief that everyone deserves a place to call home. You may have heard of mortgage insurance as you're doing your research. Mortgage insurance is a required monthly, annual, or an upfront fee you pay if you are not putting 20% down on the purchase of that property. It is there to protect the lender or the bank that is providing the mortgage in case you default on that particular loan. It is not there to protect you. FHA requires mortgage insurance, but the cost is set at 0.55 with less than 5% down and 0.5 with 5% or more being put down. FHA does not look at credit score, and it doesn't really look at loan to value too much, as explained. Conventional private mortgage insurance, or PMI, does weigh your credit score and your down payment to determine how much you will pay in monthly mortgage insurance. The less money down and the lower the credit score, the more you pay. The PMI is on a sliding scale and it's based on risk. FHA can outshine, but it can also lack depending on the situation. So this is where you need to weigh out the options, whether it makes sense to take advantage of a conventional loan or an FHA loan, and I'm here to help. While FHA mortgages offer a world of benefits, it's essential to be aware of the hidden fees and potential pitfalls. So let's uncover them. Remember, this is a government-backed mortgage. I guess you could argue that, really all mortgages are government-backed right now, but that's another topic for another video. So if it's government-backed, of course, there's going to be some sort of cost. First up, the upfront mortgage insurance premium, or UFMIP. It's a fee equal to 1.75% of the loan amount. Unlike conventional loans, this is a mandatory for FHA loans regardless of your down payment or your credit score. You're not getting around this, so don't even try. You can finance this or the cost into the loan, or you can pay for it up front in cash, but it's required, and it can be hefty as it's a percentage of your loan amount. The larger the loan amount, the larger the fee. Then there's the annual mortgage insurance premium. Unlike its conventional counterpart, which can be removed once you reach 20% equity, FHA's version sticks around. For most, it's for the life of the loan, meaning you'll be paying for it as long as you have the mortgage. If you put down 10% or less, you will pay for mortgage insurance for the life of the loan. This is a cost that will not be removed no matter how much equity you have in the home and no matter how long you've been paying on it. The only way to remove the mortgage insurance is to either sell the home or to refinance the home. If you refinance the home to a conventional loan to remove that mortgage insurance, number one, you're going to need to have 20% or more equity in the property. Of course, there's some alternatives to that. You can do a lower mortgage insurance if you have like 85%. However, you need to outweigh the benefit. Does it make sense to incur the cost of refinancing? What is the current market rate? Ultimately, does the benefit outweigh the cost? There are all kinds of thoughts on this topic, and we'll go in depth on another video, but it boils down to your plans. How long will you be in the home? Will you be there for long enough to recoup or recapture the cost and benefit from the new mortgage? If you are someone that is putting more than 10% down and you end up taking advantage of an FHA mortgage for whatever reason, you will see that mortgage insurance will be removed automatically after 11 years if you do not refinance the property. All right, property standards. FHA has strict property appraisal and inspection requirements. If the home you're eyeing doesn't meet these, you might be in for costly repairs before the loan is even approved. They do have their nuances, but for the most part, if the home is up to code, there really shouldn't be too much of an issue. However, over the years, from time to time, an agent will get burned on a deal due to an FHA required repair, and the misinformation will spiral out of control about an FHA borrower and the appraisal being done on that particular home. And so it just goes down that train of misinformation, and FHA gets a bad name and gets a bad rap. Now, sellers can be wary too. Some sellers have been hesitant to accept offers with an FHA financing, fearing potential repair requirements, and this can limit your options in a competitive market. This falls in lines with the rumors and misinformation out there about FHA mortgages. From time to time, a seller will get burned, and that reputation of FHA gets trashed once again. Warren Buffett said it takes 20 years to build a reputation and 5 minutes to ruin it. Keep that in mind. Like all things in life, FHA mortgages come with their set of pros and cons. While they open the doors for many, it's crucial to walk through those doors with both eyes wide open and be fully aware of the potential pitfalls. To make an informed decision, it's crucial to understand the exact differences between FHA and conventional mortgages. So let's break it down. Down payment. Conventional loans often require up to 20% down, but definitely 3% is the minimum for first time. But FHA, you can get it with just 3.5% down if your credit score is 580 or higher. That's a significant difference for many home buyers out there. Credit score. FHA, shines here. While conventional loans typically want scores of 620 or higher, FHA loans can go as low as 500, though with a little bit higher down payment. Debt to income ratios. FHA offers more leniency. Where conventional loans might limit their DTI to 50%, FHA can stretch as high as 57%. Closing costs here is where FHA can really be a game changer. Sellers can contribute up to 6% of the sales price towards the buyer's closing costs with FHA, compared to only 3% with conventional loans. In today's fierce market, every dollar counts. That extra 3% in closing costs can mean the difference between sealing the deal or watching your dream home slip away. Mortgage insurance. While both types have it, FHA stays for the life of the loan if you put down less than 10%. Conventional loans drop off once you reach 20% equity. It's a cost to consider, so it's one that you got to weigh both options. In the end, the right choice depends on your situation. FHA's flexibility can be a lifeline for many, especially in today's challenging market, but always weigh the long-term costs and benefit. Now here's the curveball. FHA mortgages aren't just for first-time home buyers. That's right. Whether you're buying your second home or your 10th home, FHA could be a perfect fit for you. Many believe that FHA loans are exclusively for those dipping their toes into homeownership for the first time, but that is one of the biggest myths out there. Whether you're a growing family needing a bigger space, empty nesters downsizing, or a young entrepreneur looking for a change of scenery, FHA remains an option and will continue to remain an option. And right now, it is one of the best options that's out there. Remember the perks we discussed: low down payments, flexible credit scores, and accommodating debt to income ratios. They're available to all eligible borrowers, not just first timers. And for those who've lived abroad or in different states and are now looking to settle or invest in a property, FHA can be your trusty companion in navigating the U.S. housing market. So whether it's your first venture or another addition to your real estate portfolio, don't overlook FHA mortgages. It's a versatile tool designed to cater to a wide variety of homeowners and home buyers. If you like what you saw today, please give me a thumbs up. We appreciate it very much. I can't thank you enough for watching. Please do me a favor, subscribe, share. Hope to see you on the next video.